So for those of you who haven't been here before, my name is Sujata Shyam, and I am the CEO and founder of Lux Capital, and I host these webinars, these masterclass series, because it takes time to learn any different type of investment and get comfortable in it and become confident. And I realize that there's a lot of jargon and things that take some time to wrap your mind around when it comes to investing in real estate syndications. And I really want people to have access to this type of investing because it is so very powerful. And I'm really passionate about closing the investing gap and about helping more people build equity so that they can have time freedom and achieve whatever goals that they want, that their financial that their financial situation can provide for them. So today we are going to just review one of the biggest myths that investors have regarding syndication investing, and we're going to talk in depth about IRR and why that's so important. And so just quickly, the biggest lie that investors tell themselves about syndication investing is, I won't make that high of a return. And I always want to ask the question, well, compared to what, right? Because if you just leave your money in your checking account, or even if you leave it in your house, for example, if your house has increased in equity since you purchased it or you've paid it off, then that money is not doing anything for you. So that money is making 0% for you, which is a whole heck of a lot less than if you're investing that money. And so that mindset keeps many investors sidelined from investing in real estate. And we don't want that to happen to you, right? So my name is Suja, and just a little bit about my story. I never really wanted to have a regular career. And I can accredit that mostly to my dad, who I love and who was a devoted employee of IBM for 30 years. But one of the things I remember about coming home from school is just knowing that my dad, or hearing him say that he's just bored at work. And that was pretty much in my mind, that became like the thing that I just never wanted. I never wanted to be bored at work. And when the real world came along and I graduated from business school and needed to pay bills, I ended up getting a job. And guess what? I was bored at work. And I tried a bunch of different things, and I just never found something that really, like, for me personally, I just had to come to terms with the fact that I wasn't meant to be an employee and that I would always kind of be bored being an employee. So anyways, fast forward, I ended up becoming a real estate entrepreneur and building an Airbnb portfolio. And that's how I replaced my income from corporate. And when I did work in corporate, I was still working in real estate. I was underwriting for large institutional investors in deals much like the ones that we are investing in today. But the beneficiaries were large institutions, banks, pension funds, life insurance companies, et cetera. And they were not private investors. And at the time, 10 years ago, I had no idea that private investors could make money on these types of deals. And when that world opened to me, I just realized that, like, wow, there are just so many people who deserve to have access to this type of information and this type of investing, so that they're not stuck in the rat race and stuck in not building wealth. So fast forward over the last couple of years, we've invested in a bunch of different properties, self-storage, multifamily, ATMs, and we have over 250 verified investors and over 40% repeat investors, which is something that I'm really proud of, because, it makes a huge difference to me to know that people are having a good experience and want to come back. Here's some pictures from the last few years doing due diligence, starting my podcast, and visiting construction sites of deals that we're investing in. And it's been a huge, awesome journey, but you're not here for me, you're here for you. So let's dive into it. This is just to orient you. We are doing kind of an intro series into passive investing. And these are I think there's one missing, but these are the six of the ones that we have already done before. Key terms and players and syndications, 3 secrets to control, 5 ways your money makes money, the crux of equity growth, demystifying the capital stack, understanding the fees and syndications. And today we're talking about IRR, which is one of my very, very favorite topics. So very glad that you're here for that. And just a quick disclaimer, this is for your education only. Make sure you're talking to your attorney or your CPA. We're not offering any sort of tax or legal advice. This is purely for educational purposes. Okay, so now for the presentation. Let's talk about deals. And I would love for you to all just put anything you want into the chat. If you invest $100,000 in a deal and get $200,000 back total, is that a good deal? So feel free to type into the chat and let me know what you think. Okay, I don't have any responses yet, but that's okay. All right. So is it a good deal? Well, the answer is, okay, Sanjana says, okay. Oh yeah, no worries, you guys. I mean, I know you might be on the phone or something, so I can only direct message. Oh yeah, okay. Depends on the amount of time, energy, etc., says Jennifer. I think so, especially from a 21 years old perspective. Very good. Pretty good deal. Thanks, Justin. Okay, so thank you for your responses. And, Jennifer, we're going to talk about your topic. What you said depends on the amount of time, energy, etc. And that's such a good point. Like, we're here talking about time. You happen to mention energy, and that's a really good point. How much energy do you have to put into a deal? So we're all here talking about passive investments. So that's the good thing about what we're doing, is that we're talking about not having to be a landlord, which is a huge weight off anybody's back. Okay, so we're going to go to my Excel sheet. Let's look at scenario one. Okay, you put in $100,000. Year one, you get $7,000 back. Year two, you get $7,000 back. Year three, $7,000, etc., all the way until year 10. And then at year 10, you get your $100,000 of principal back, plus you get another $37,000. And so when you add up years 1 through 10, you get a total of $200,000. Okay, so that sounds pretty good. What is the IRR? The IRR in that situation is 9%. And, if you can see this is how we do the IRR calculation. You have to put your principal amount in as a negative number. And then you put, this is an IRR calculation just based on years. There's a way to do, you can use X IRR function if you want to calculate it based on the exact dates that you're receiving things, receiving payouts, which is definitely something you could play with if you are Excel savvy and really like playing with spreadsheets. But the more simple IRR calculation is simply like this. You input on an annual basis, the amount of returns you're getting. And then one of the tricky things is that you have to, in year 10, you have to put both the cash flow and the appreciation and your return of capital all in one cell. So, you can see here, we've got we've got $100,000 plus the $7,000 of cash flow. And then there's another $30,000 there. That would be the gain from sale in this situation. So that's all the money that's coming back to you in year 10. And so that all has to be there when you calculate the IRR. And so in this case, a 10-year deal, the IRR is 9%. Okay, let's look at the next scenario. Okay, so same thing. However, you put in $100,000, $7,000. However, you get all your money back plus the extra in year 5. So instead of getting $200,000 over 10 years, you get $200,000 over 5 years. And look at the IRR. It jumps to 16%. Okay. Now we're going to go to, I think you're kind of getting the hang of it here. We're going to go to scenario 3. So same thing, you put in $100,000 in year 0, and then you get $7,000 back year 1, $7,000 back year 2, and then you get all of the rest of that $200,000 back in year 3. And then the IRR jumps to 27%. So as you can see, time matters. If you get $200,000 back in 3 years, that's a whole lot different than if you get $200,000 back in 10 years. So now let's look at some other different types of returns that some of you may be familiar with, but this is just review and hopefully you'll gain some new insights. So here's the scenario 1 that we went over. Okay, so we had a 9% IRR, if you recall. What's the ROI? Okay, so ROI stands for return on investment. And, we put $100,000 in and we got $200,000 back. That means we made or profited $100,000. So this is pretty simple. We doubled our money. We're keeping the numbers simple for the sake of this explanation. So ROI is 100%. Now, if you look at all those 3 scenarios, the ROI is similar. It's the same, exact same across all 3 scenarios. So that's just something to keep in mind. ROI, return on investment, is not necessarily tied to the timeline. Okay. Next, we've got average annual return. That's also sometimes called annualized return. And let's look at that. So in scenario 1, the 10-year scenario, the average annual return is 10%. So think about it like we made $100,000 because, we took $100,000 and we turned it into $200,000. So we made $100,000 and divided by 10, then you get 10%. In the 5-year deal, the average annual return is 20%. So you take $100,000 and divide it by 5. And then in the 3rd scenario, the 3-year scenario, the average annual return is 33%, or, $100,000. They're 100 divided by 3, 100% divided by 3. So the average annual return is also like a decent metric to compare deals across deals, because you want to be able to say you're looking at one deal and then you're looking at another deal and you're looking at another deal. Well, if you just look at the ROI, you're not necessarily going to understand the IRR and the time value of money, that is how that associates with it. So the AAR is also, it's oftentimes people will use the AAR, the annualized return, because it's easier for people to understand than IRR. But that's why we're here today, so that you can really get a handle on the IRR. Okay, and then we're just going to go over a couple more terms. So cash on cash return, you may see this. I mean, you will certainly see this in different deal scenarios. So cash on cash return refers to how much cash you get per year over the life of the deal. And that's cash flow. It doesn't include the appreciation. So in all these examples, we're getting $7,000 back every year before the year of sale. And so in each 3 of these scenarios, the cash on cash return is 7%. So that's the same across all deals. And then the equity multiple, that's another term you're going to see. That's 2x. So let's say like people want to double your money. That sounds really good. People love the idea of doubling their money. And so that's what equity multiple is. It kind of demonstrates to investors, okay, I'm going to double my money. However, equity multiple does not take into account the time value of money, right? Because it's the same across this 10-year, 5-year, and 3-year scenario. So why does it matter how long it takes to get that 2x equity multiple? Why does the IRR important? Okay, so let's go back to the slides. Let's see where we are. So first of all, here is the IRR calculation. It's not actually an easy calculation. You can't actually easily do it at home. So I always just do it in Excel. But the whole point of it is that it is measuring the time value of money. So why is the time value of money important? So I love to quote this quote by Albert Einstein: compound interest is the 8th wonder of the world. She who understands it earns it. She who doesn't pays it. And so this is why IRR is such an important term for you to understand, because it relates to compounding interest. As real estate investors, we always want to be putting our money to work. We want it to be working for us. We want our equity to be working for us. Of course, we don't want to be over leveraged too much. Like we want to be able to cover our downside, and we want to have a balanced portfolio with appropriate amount of risk, but we want our money to be working for us. Okay. And that's why the IRR matters so much, because in this scenario, the 10-year scenario, where you don't get your money back until year 10, that money is not making more money for you. If you get that money back in year 5, then you can invest it again right here. And then you'd have another $200,000 at the end of year 10. So you'd literally have twice as much money than you would as if you waited to get that money back in 10 years. Does that make sense? And then in the same thing with year 3, you would like literally have about triple the money you would have, or actually it's probably more than that because of compounding interest and exponential growth. But the point is that like waiting till year 10 to get your money back is not advantageous, because you could be reinvesting in that earlier on if you got it back earlier. So getting your money back early is something that's one reason why syndicators are often trying to refinance, right? So what a refinance is we buy a property, we stabilize it, but maybe we don't want to sell it just yet, but we can refinance it and we can take cash out and return it to our investors. And then our investors can go take that money and put it in another deal. See, this is really part of getting in the mindset of being an investor, is you want to take your cash out and you want to reinvest it as soon as possible. So why is that important? Okay, we're going to look at another Excel sheet and just look at compounding interest and why that is so important. So let's say you put in $100,000 and it grew at 1% a year. It's not going to grow at 1% a year in most savings account, by the way. At the most, you might have a savings account if you have a high yield savings account where your interest will grow at 2% per year. So let's just say it's growing at 1% per year. Then by the end of 30 years, that $100,000 is going to turn into $134,000. I mean, that doesn't sound that bad, right? I mean, you didn't do anything, right? You just let it sit there and you got $134,000. However, what if you were to be able to invest it at 4%, for example, in maybe some kind of bond situation? I know my dad invests in certain kinds of bonds, and I think he gets 4% tax-free in municipal bonds. So then after 30 years, that $100,000 turns into $324,000. Well, that's a whole lot better than if you were investing it at 1%, right? But what if you were actually able to invest it at 15%? Okay, so that's like a typical IRR for one of our deals, somewhere between 12 and 15%. So if you're able to invest it at 15% and keep that money working for you, then at the end of the 30 years, you'll have that $100,000 will turn into $6.6 million. Okay. That is a staggering amount of money. And this is why compounding interest is so important. Like, how old are you right now? If you're 50 years old right now, do you think you're going to live till you're 80 years old? Well, if you think you're going to live till 80 years old, how much do you have left in your retirement? And how much do you think you're going to need? Like, are you going to need long-term care at some point? Are you going to want to go on vacation or take your kids on vacation? So these are like, even if you're at an age where you're thinking about retiring, because people are living so much longer, this is why investing and putting your equity to work is so important. And you can see that it changes pretty dramatically. Like if you're only able to earn a 12% IRR, then instead of having $6 million, you only have $3 million, but $3 million is still quite a lot of money, especially when it started out as $100,000. But the problem is if you don't start it now, then you won't get there. So like, let's say you delay a year. Okay. You delay investing a year. You delay investing $100,000 by a year. Then, and let's say you were going to make a 12% return, just to be conservative. So then instead of getting $3 million, you have $2.67 million. So you actually lost $300,000 just by delaying it a year on a 30-year time horizon. And so now I'm going to go down to this curve and zoom out a little bit. So here is a graph of this curve that we're talking about. So with compounding interest, you can see that it takes a while for it to get exciting, right? Like the title of my podcast is called Passive Income Unlocked. And it is possible. There are certain types of deals where you can get passive income pretty quickly, but for the most part, it takes time for it to get really exciting. Like you can see, like on a visual scale, it doesn't actually look like it's growing very much for 5, 10 years. And then somewhere around 12 years, you can start seeing it growing. And then around 15, 18, 20 years, then it gets really exciting. And that's not to say that you can't find ways to benefit from your money earlier on in your investing career. But the key is, like, the sooner that you start and the faster that you're keeping your money moving. And there's this term velocity of capital. You want to keep your money moving and reinvesting it so that you can, maybe you don't need $6 million, right? But if you're investing it at a 15% IRR, then you can pull some of it out and you could still probably, get a retirement of like $4 million and still benefit from the investments that you're creating, just depending on how you're doing it. So this is why the IRR is so important. And if you're ever looking at deals, that's the best way to compare deals, is to compare the IRR. Of course, there's like several other factors that, may contribute to what matters to you. And we'll go into this in a second. So IRR is the best number to use to compare. It's kind of the industry standard. And that's why we're spending so much time understanding it right now. Just a quick note, the IRR will be negative until all capital is returned, and then it's 0%. So, if you're ever doing calculations, then, it's going to be negative until you count the return of capital in there. And we already talked about this is why syndicators are going to work on getting refinances. It's one of the reasons why we like monthly distributions, because the sooner we get money back in your pockets, the sooner you can put that money back to work. And maybe, maybe you're not going to put all of it back to work. Maybe you're going to use some of it for, whatever your life goals are. But we want to get money back in your pocket so that you can keep putting money to work. And early sales are popular because if we can hit, the same average annual rate or the same equity multiple in a short amount of time, then, we can really boost your ability to build wealth even more quickly. We don't necessarily like to project early exits, but, but it is something that we usually go for because of velocity of capital. Okay, so what to expect. So different types of deals are going to have different types of IRRs. For example, a value add building, which is similar to like this Houston deal that we just released, is a value add B-class property, which means that we are going to renovate a bunch of the units. In this case, probably 100% of the units. We're going to improve the common areas. We're going to do a whole bunch of upgrades to make the property nicer. We're going to make the playground nicer. We're going to add more grills to the pool area and make the pool area nice and resort-like feeling, and just make it a nicer place for families to live. This is a working class workforce housing building. And, we have a lot of families that live there and we want to make it as nice for them as possible. But there's a lot of upside, right? Like we're going to actually add a lot of value, make some upgrades. And because we're putting in all that effort, then we can get a higher return. And so typically you might expect a 14 to 17% IRR on a value add deal. So on a stabilized deal, that's like an A-class deal that's already kind of at the top of the market. Potentially, we're not necessarily going to be doing so much construction or turning the units. There's going to be a different business plan. Maybe we're just going to be adding a dog park or adding reserve parking or just optimizing the operations so that we can kind of take advantage of what is not currently being done at the property, but we don't have to do the heavy lift of renovations. So in that case, it's less risky in a sense. I mean, people always, anytime you do renovations, there is going to be some risk, right? Like there's lease up risk, there's construction risk. And so we're always trying to place ourselves on the risk return profile, and we want to kind of have optimized returns for the amount of risk that we're taking. So in any case, in a stabilized asset class, you might expect a lower IRR. And, we may be offering some deals in the future that are more around a 12 or 13 IRR. And the thing about those is that they're, that creates potentially a balanced portfolio where you're not being so aggressive on every property, but you have some properties where it's like pretty much just like a pretty stable, good bet. And it's just it's on a different place in the risk return profile. So that's what to expect as far as IRR. Our last deal that we put out is at about a 16% IRR. And I want to go over this chart with you. So preferred equity. I have not currently offered a deal with preferred equity, but we may offer it in the future. And it's in preferred. And so I want you guys to understand what it is. So preferred equity is when you sit in the capital stack ahead of the common equity. And when preferred equity, the idea is that you're going to get cash flow consistently throughout the deal, but you're not going to participate in the upside. So in this example, that's right here, the preferred equity is getting 9% per year in cash flow returns. So it's like they're going to get paid before everybody else. I mean, after the lenders, but before everybody else, 9%. And that's kind of the better situation to be in. Like sometimes deals only return 1, 2, 3, 4% in the first few months. And then it kind of fluctuates. And if you're the type of investor, or if you just want some investments to just provide you with basically what they call a coupon or a straight investment return, 9%, then you can get preferred equity. So in this case, the IRR is going to be 9% because you're getting 9% every year. And that's all. And so that's going to be the same as the cash on cash. If you are a common equity, which is all that we've done so far for the most part, then you may want to look at our sensitivity test to understand the range of possibilities. Like we always want to understand, what do we think the worst case scenario is? What do we think the best case scenario is for any investment that we're in? And IRR can be very sensitive to various different kind of metrics that we can kind of toggle up and down. So in this example, we are looking at the deal sensitivity to cap rate. And we're not going to talk about cap rate right now, but cap rate is basically, it's a measure of how hot the market is. And if people are going to be paying more for an asset than they were. So if it's a hot market, then the cap rate is going to be lower. If it's a soft market, the economy is maybe not doing as well, then the cap rate's going to go up. So where it says 3.92, this is kind of the best case scenario. And the IRR is going to be 19.2%. This is just another example. It's not related to the other example. And then if the market softens, then the IRR could go down as low as 10%. However, 10% IRR is still pretty good. I mean, if you can go back to this chart, if you're able to invest your capital at 10% every single year for 30 years, then $100,000 is going to turn into $1.7 million, which is still pretty good. So it's still really good, in fact. And so, but you want to look at the best case scenario too. We don't even have 90% returns on the chart, but I mean, that's probably going to be like, if I was to guess, that would be like, you'd have at least $20 million at the end of 30 years if you were able to invest all your capital continuously at a 19% IRR for 30 years. That, and starting with 100,000. So that would be the best case scenario, and that's laid out in this chart anyways. And then you can kind of see that we're also checking out the average equity multiple, like how that's going to change as the cap rate changes, and how the annualized return is going to change as the cap rate changes. And so this is a really important exercise for every investor to understand, is doing sensitivity analyses on not just cap rate, but there's other ones like rent growth, expense growth. And, one good way to do it is say, okay, well, let's look at kind of what we think the worst case scenario is for all of these different categories. and then look at where we are and in the best case and worst case scenarios, and then what we think our likely scenario is. And that way we kind of understand like, okay, this is generally where we're headed as as an investor and with this investment. So another thing to keep in mind is like when you're looking at IRR, it's, you can't just take it at face value, because as the numbers can move very, very quickly, depending on what you put in the underwriting model. Underwriting models can be very sensitive. So, a 3.92 cap rate might not sound that different from a 4.2 cap rate, but it might have a tremendous impact on the returns. And so one thing you really have to do is feel comfortable with the operator that you're working with. Do you feel that they're committed to producing conservative returns? Do they really understand the market? Because if rent growth is not going to meet the targets, that could really affect the model and the returns. And, what kind of asset class are you in, and where is that asset class in its maturation, right? So multifamily, for example, is a relatively mature asset class. RV parks, for example, not mature. They're probably on the very, very low end of maturity. Self-storage is probably somewhere, like around 25% if we were to go from a scale from 0 to 100. And mobile home parks are probably maybe like 50 or 60%. So there's still some runway there. So understanding what the potential upside is going to help. I mean, it's just one of the things that's going to impact the IRR. So multifamily, it might not have as high of an IRR as an RV park because it's a mature industry. However, there's ways to find good deals. Like if you do find a really smoking deal, then you could have a really high IRR still. Break-even occupancy is another is something else you really want to look at, mostly to look at your downside protection and your backside, because what the break-even occupancy will tell you is what vacancy or occupancy metrics you need to hit in order to not lose the property. Because, the worst case scenario is that the bank forecloses on your property, takes it back, and you lose all the equity. That's when things really go sour in real estate deals. And you really want to make sure that your break-even occupancy is very, very strong. So I think that kind of covers, so I wanted to go over this chart as well. So this is kind of just like, I wouldn't take this as gospel by any means, or like, that this is the only way to do it, but it's just a chart that you could refer back to just to kind of understand, how conservative a deal is. So in this ideal column, you probably aren't going to get all of these in any one deal, but if you did, then that would be a really good deal. So for example, a class B or C would be really great because it means there's tremendous upside. And when you have more than 100 units, that you're benefiting from the economy of scale. And based on a 5-year hold period, doubling your money in 5 years, it's pretty much the industry standard. If you can hit that, that's very positive. That would create an internal rate of return of over 16%, very positive. So type of loan, non-recourse agency debt. What this means is that there are certain types of loans where they're non-recourse. So whoever the lender is, in this case is basically the government, is not going to go after anybody's personal assets. And that is a really strong kind of loan to have. It's a good loan. It's a very secure loan. If the loan interest rate is fixed for 7 to 10 years, that's ideal because, we don't want to necessarily be subject to interest rate risk. And if we know it's going to be fixed for 7 to 10 years, that gives us a lot of security. And reversion cap rate, if it's more than 0.5% above the entry cap rate, then, it's just one benchmark to determine how conservative the sponsor is being. And if rent comps are higher than the subject property, that's really good. So if you know that comparable properties are renting for higher than your property is currently renting for, then there's a really good chance that you'll be able to increase your rents to market rate, which will have a whole slew of impacts. For example, it'll spur the creation of more housing. And also, we're always improving the properties and making nicer places for people to live. And if the projected rent growth it's considered conservative if it's less than 3% per year. We try not to predict any more than 3% rent growth, but certain markets do warrant it. And it is important to be able to also be competitive and win deals. So we're always kind of trying to balance being conservative and winning deals. Of course, the most important thing is capital preservation. So that's always at the forefront of our mind. Capital preservation is the most important thing. That's part of our investment philosophy. Next is cash flow, then it's appreciation, and finally, tax benefits. And lastly, vacancy. A really conservative vacancy is 10% per year. That's not necessarily realistic to project all the time because it doesn't necessarily provide the best service to the investors to project a 10% vacancy. But if a 10% vacancy is projected in a strong market, then the deal is really, really conservatively underwritten. So all of these metrics will, and the reason we have this here is because all of these metrics kind of influence like what the IRR ought to be projected at or how it could be impacted. And that's pretty much what I wanted to say today. We covered a lot of ground, and I'd love to hear if anybody has questions. So please feel free to type them in the chat or say them. And thanks for coming. And thanks for investing in yourself and investing in your own knowledge and education on the investing front. It's really great to see all of you.